Well, folks, I gotta say, the Google algorithm and the YouTube algorithm, they just know me too well. I can't go on either without having to click on a bunch of stuff. And last night I was surfing around on Google, and I know that's weird. Who the heck surfs around on Google? But I actually do, okay? Because that algorithm knows me so dang well. It's gonna feed me some information I want to hear, okay? So anyways, last night I was on there, and I got this, article requested to me. It said, got $5,000. These 3 explosive stocks could make you richer in 22. And so I was like, And so I was like, let's make a video out of this today. Let's go ahead. Let's talk about these 3 stocks. Yeah, they're talking about a Motley Fool here. And let me give my 2 cents if I think these stocks are going to make you richer in 22 and beyond, in my personal opinion. So yeah, I hope you guys enjoy this video as always. By the way, I want to say thank you to everyone who is subscribed over at Financial Education 3. We hit 100,000 subscribers on that channel literally last week, which is our 4th silver play button from YouTube now. We got one for Financial Education, the main channel here. We got one for Financial Education 2, one for Financial Education 3 now, and then we got one for Millennial Money. So yeah, thank you to everybody that's subscribed over there, and obviously thank you to all you guys that are subscribed here on the big channel as well. I appreciate you guys. Much love. And anyways, yeah, let's get into this. And let me know if you enjoy a reaction video where I give my opinion on 3 different stocks that I don't usually talk about on the channels much, okay? Alrighty guys, so the first of these 3 stocks they're talking about will make you a lot richer in 22 is TDOC Health. TDOC, okay? Wall Street's consensus price target for TDOC stock over the next 12 months reflects a 67% upside potential. I think that's analysts' bullish view about the company is warranted. It's quite possible that the spread of Omicron Roni could give TDOC a boost in the near term. If new case counts stay high, and they have, and they will, okay, and they have already become or rise significantly from here, many individuals could once again start opting to use virtual healthcare rather than visiting physicians in their offices. TDOC enjoyed a big surge in virtual visits in 2020 thanks to the pandemic, obviously. It could very well happen again, especially in the early part of 22. The company's contract with HCSC, the 5th largest health insurer in the United States, goes into effect next month, and its new virtual primary care service, Primary 360, which if you listen to the TDOC conference calls, they talk about Primary 360 all the time on those dang things, continue to gain momentum. So TDOC should enter the new year with a strong tailwinds. But these near-term catalysts aren't the main reason to like this healthcare stock. TDOC's market cap of around $15 billion is low compared to the long-term opportunity for virtual healthcare. Well, I think the stock will make investors richer in 22. Its returns over the next decade should be more impressive, okay? So, alrighty, TDOC. What's my opinion on this one? Buy, sell. So, in regards to TDOC, yeah, it's a long-term buy. Absolutely. I've researched the space a lot over the last couple of months. I can't find anybody that's in a better position to capitalize on virtual healthcare over not just 22, but over the coming years, okay? Now, with that being said, this is very, very important here. The stock is in a position where it is set to likely bounce back in 22, right? It's in a pretty darn good position. There's just no doubt about it. But you got to understand with the stock like TDOC, this is a money-losing company. And although, and we'll get into the other 3, but I'm going to speak about this for a moment. And when you're in a money-losing company, the stock doesn't have to go up in 22, and I think that's the important part people got to understand with the stock like TDOC. This is a company that if you're investing in TDOC, I don't think you should be investing in it from the perspective of, I'm going to make a bunch of money in 22, because keep in mind, 22 will be a year where virtual healthcare will not be nearly as important, especially in the back half of the year. Cases are going insane right now for Rona, okay? They're going to peak out likely in January, and then in February, they're going to start dropping as we go further into the spring, March, April, and we go further in. Their cases are going to go down massively, more than likely. That is my prediction. I'm no doctor. I just look at numbers, okay? And that is what is likely going to happen. And then any enthusiasm around that is going to be gone, right? And so keep in mind, there's already not a heck of a lot of enthusiasm. There's no enthusiasm even right now with cases going insane. And look at TDOC stock. It can't do a dang thing, okay? Like literally, it can't do a dang thing even with the cases going insane. Like we're going to hit like likely in this week, the highest numbers we've ever hit since the pandemic started, okay? And even with that being said, where's TDOC stock going right now? Nowhere, okay? So something to keep in mind is it's going down, actually. And so something to keep in mind is this stock doesn't have to go up in 22. And if you're investing in this just from a, hey, it's going to go up in 22 perspective, we're the bullish catalyst for this company in 22, right? There's not really any major bullish catalyst that we don't already know. They're going to report good numbers. I mean, a strong growth, right? But do they beat earnings estimates? That's the big question, right? And so this is a stock I look at, long-term opportunity. It's there, man. And there's no doubt this is a company that could be $100 billion plus market cap. But if you think this stock is going to be a beast in 22, it might not, okay? Just flat out. There's not like there's nothing that's coming for the stock that's necessarily a huge bullish catalyst unless people are buying in, right? Now, the good news is if Cathie Wood does start to ever get inflows of money to 22, it's likely she could start buying more TDOC stock. So that is something to keep in mind there. And she's obviously a massive buyer in the market. That's usually between their second and third biggest position in the main ARK fund, all right? And so obviously it's usually a good thing if Cathie Wood's on your side as well, all right? So that's one of my 2 cents there. I like TDOC for a long-term perspective, no doubt. I just, if you're thinking this is, easy money in 22, I just to say, think again, just for the mere fact that, it doesn't have to be. When you're an unprofitable company and you don't have any massive major bullish short-term bullish catalyst, they're just going to execute likely this upcoming year, okay? So, yeah, that's my opinion on TDOC there, okay? Next one up here. Wow, I don't think I've ever talked about this company in the history of my YouTube channel, so that's for dang sure. Number 2 or 3, Mercado Libre. Analysts are even more optimistic about Mercado Libre. MERI is the ticker symbol on this one. The average price target for the stock is more than 60% higher than its current share price. I suspect Wall Street could be right again in this case. Mercado Libre reigns as the biggest player in Latin America e-commerce market, and that's a market that could more than double in value by 2025, according to Morgan Stanley. E-commerce isn't its only focus, though. It also hosts large digital payments ecosystem in Latin America and is a leading provider of logistics services to merchants in the region. Both those businesses continue to grow rapidly. If you look only at Mercado Libre's price to earnings multiple, you might think the stock is ridiculously expensive. However, its shares are actually trading at historically low levels based upon the price to sales ratio. PS, okay? A more meaningful valuation metric for Mercado Libre at this stage of the company's evolution, all right? And yeah, I mean, if you're super high growth company, usually it is better to probably look at the price to sales ratio, because a lot of times super fast growth companies, they're just not focused on profitability at all. So you're kind of fighting a losing battle, especially if you're looking at trailing 12-month PE. Forward PE might be a little different, right? But especially if you're looking at trailing 12-month PE, which is what most people look at, yeah, you're fighting a losing battle there if you're judging a massive growth company off that. It's just, you'll never buy anything if you're looking at that, just flat out. You'll never ever buy a high growth stock if all you look at is trailing 12-month PE. Believe me, that's how I got started in the stock market. I was always look at the trailing 12-month PE for all of my stocks, and I'd be like, oh my gosh, Amazon's trading at 100. You got to view those companies totally different, and you got to really be able to run projections on where revenue and net income will go in future years. That's what's really important, okay? So when it comes to Mercado Libre, yeah, they're in a really, really good position. This isn't a stock I track on a high level. I tell you that much. I track it on I would call it a low level. And they're in a really good position for the next, this whole pretty much decade, to be quite honest, all right? If we look at the stock price, it's been anywhere from $2,000+ to down to about $1,000 in its past 52 weeks. Right now, it's at $1,300, so it's much closer to 52-week low than 52-week high. As far as a market cap, about $65 billion market cap on this one. Yeah, if you look at PE, it looks insane, right? 825, but it's not a PE play right now. That's just not the truth. So if you look at it from this perspective, this is what's really exciting from what I saw. $3.03 of EPS expected in 21, but look at that, $8.80 expected in 22, and that's why you don't look at trailing 12-month PEs or anything like that. Look at the future when it comes to these sorts of high-growth companies, because that's what matters. And $8.80 would be quite an impressive number to put up there. If you look at revenue growth, expected 75% revenue growth this year, 35% plus next year. Look at this, $9.46 billion expected on average from 21 analysts that cover the stock. That's the average consensus, right? From 6.97 expected in 21. But the high analyst has it at 11 billion. So nonetheless, I mean, this is a fast growth company that has a huge TAM they're going after that's just going to get bigger and bigger and bigger. And yeah, they're in a really good position. And I will say, if you want a Latin America play, this looks like the play, to be quite honest. I haven't found anything that's more compelling for, a Latin American play than Mercado Libre, to be quite honest. So yeah, I say, I can't deny this one. If you're looking for that sort of company, do I think there's other better opportunities in the United States for other stocks? Absolutely. But if you're looking for a direct play on Latin America, I think it's the play. Okay. So that's that one. So now let's get into the next stock here, and then I'll share one stock that I think is easier money than any of these stocks in 22, okay? And we'll talk about that one at the end here, okay? But third stock that they have here from Motley Fool is PayPal. There's plenty of enthusiasm about PayPal, PYPL, on Wall Street. The consensus price target for the fintech stock represents an upside of 43%. Could it really deliver that kind of gain in 22? It's quite possible. The company should have a happy new year, in large part to Amazon.com. Who calls it Amazon.com anymore? This is hilarious. Just call it Amazon. Beginning in January, the world's largest e-commerce platform will allow customers to use PayPal Venmo app to pay for purchases. That's big, by the way. That's huge. PayPal CEO Dan Schulman said the company's third quarter earnings call that Amazon deal marks a very significant moment in our Venmo monetization efforts. Absolutely. It also continues to win greater adoption for its payment apps in physical locations. Valero, Phillips 66 are adding support for PayPal QR codes in gas stations throughout the U.S. United Airlines now allows PayPal QR payments on flights. Interesting. Hey, QR finally taken off after all these years, right? With its shares trading at 35 times expected earnings, PayPal might not seem attractively valued. It's attractively valued. That's all I'll say about that. But based on the massive growth prospects for digital payment space and the company's leading position in the market, I think it could truly be an explosive stock in 22 and over the long run, okay? Yeah, in regards to PayPal, easy money. Easy money. That's all I'll say about that. If I was to say, and I'm going to share an even easier money stock than PayPal here in just a moment. But yeah, if I'm going to say out of these three stocks, Motley Fool's talking about here, there's no doubt PayPal is the easiest money of these three, in my personal opinion, if we're just judging off a short-term basis like 22, okay? The deal with Amazon for Venmo is massive, okay? Massive. And keep in mind, PayPal controls the number 2 and the number 3 most popular financial-related apps in the entire United States of America, okay? The only thing that's usually above them is the Cash App, which is owned by Square, SQ, which is also an interesting valuation, just not as easy money as PayPal in my personal opinion, okay? Market cap recently has been trading around $225 billion. This is one of those companies that if you're thinking about a company long-term that could enter the $1 trillion boys club, PayPal's got a legit opportunity, to be quite honest, okay? PE on the stock's 46. The forward PE on the stock's about 35, which is not high at all, in my opinion, for a company that still has the type of runway in front of it that PayPal does over the coming years. 52-week high on the stock's 310, 52-week lows 179. This was not a stock that's ever caught up into the retail hype cycle of January and February. So if you're thinking, there's certain stocks that were caught up and they got massively overvalued. PayPal never got massively overvalued. Even at 300, you can't say the stock was massively overvalued. You could say maybe it's at fair value at 300. And I would say that, like if PayPal was trading at 300 today, say, it's pretty fair value for where it should be trading at. It's not overvalued, it's not undervalued. Under 200, it's undervalued, flat out. And it's easy money, not just in 22, but in future years. And so if you're looking at it as a more safety stock, that's the one. Volume's just been incredibly low in the stock recently, but a lot of that's because of the holiday, kind of time period we're going through, okay? So yeah, PayPal's easy money, but there is one stock I view as easier money than PayPal and easier money, and if we're talking specifically about 22, and that's FB, okay? Facebook, this is the easiest money of if we're to view those particular stocks. I think this stock's even easier money in 22. And in future years, the market cap's under $1 trillion right now. And P ratio is 24. Forward P, in my opinion, is probably under 20 for the stock and what the numbers are going to post up here. The stock hasn't been a beast recently. I think, they're going to just put up phenomenal numbers in 22, and they're trading at such a cheap valuation based upon where their long-term growth rates are. Keep in mind, Facebook has as good of growth, or should have as good a growth in 22 as a company like Amazon, right? But the difference is a company like Facebook is going to continue to put up those numbers like Amazon will, but the difference is Facebook trades at a 24 P versus Amazon trades at about a 60. Okay. And so the stock's significantly undervalued. And by the way, I think Amazon's undervalued as well. And I think Amazon's in a position that they'll probably do very, very well. Their stock price and their company's performance in 22, I think Amazon's going to do very well as well. I think it's just Facebook's going to outperform everything in 22 and in future years in terms of the big dogs, okay? And so this is a company that I look at as even easier money than PayPal. And then they're in the best position for the metaverse opportunity, right? Which the hype is going to start really coming, big time in 22 and in future years. So yeah, that one's even easier money. But anyways, hope you guys enjoyed a little video like this, something a little different, where we get into some stocks that, somebody thinks are explosive growth stocks in 22 and beyond. Let me know what you guys think about these stocks in the comment section. Much love as always. Don't forget to be subscribed to the channel and subscribe over at FE3 as well. Much love and have a great day.